talk about that, inflation, and everything else with our friend Tom Lee, Fundstrat managing partner and head of research, also a CNBC contributor. Tom, what's that refrain that the cool people on the interwebs like to say, elections have consequences? Well, they certainly have, at least in those markets. Do you see a risk here?
Well, I do think that there is a risk that there is a conservative wave in November. Not that I consider that a risk to markets. I think that unlike Europe, I think that the U.S. stock market is not going to be flummoxed by a change in parties in the White House or in Congress. And one reason for that is, well, one, history just show that it, regardless of outcomes, equities generally do pretty well post-election. But also, I think that there are maybe sectoral implications for changes in the party, but not for the economy sort of as a whole.
Yeah, that's fascinating. And you wonder if it's because, without diving into politics, Tom, I wouldn't ask you to do that. But let's be clear. From an economic policy perspective, the current guy and the former guy, when it comes to trade and stuff like that, are pretty much the same.
That's right. I'd say when it comes to sort of global trade and sort of global dynamics, they're very similar. I think the differences come with regard to things like energy policy, where I think if Trump, it wins in November, it's actually bad for energy stocks because there'd be more drilling. And I think if Trump wins in November, that it would actually be good for Bitcoin. So in some ways, watching Bitcoin and energy give you some sense for how the market is sort of judging outcomes.
And if Biden wins, it's probably just kind of more of the usual, because we have him in office now and we see what's going on.
That's right. I think that if Biden wins is that you would just have continued gridlock and potentially maybe liberal fiscal spending. And so it's not a terrible dynamic for markets. And as long as inflation doesn't reaccelerate, it doesn't make the Fed's job any harder.
Well, a beautiful transition from Tom Lee to Tom Lee, because inflation was the topic of your big investor note today. And you said inflation seems to be falling like a rock. Why do you say that? And is that necessarily good news for stocks?
Well, the reason we said that is there seems to be some skepticism from our clients about the quality of that May CPI report, which came out Wednesday, and the May PPI report, which came out Thursday, because it was such an abrupt decline in the rate of inflation from April to May. But the internals were actually much better than people realize. Over 55% of CPI components are now below their pre-pandemic average. That means a lot of the sort of drivers for inflation are actually falling away. And in terms of what it means for markets, you're right. You don't want to be in a deflationary scenario, which it's really not happening. Inflation is still in the high twos, but it's moving faster towards a target than the Fed realizes. That actually is somewhat constructive.
Well, can you blame your clients from wanting to see maybe a couple of months of proof? Because every jobs number has been basically revised the other way. You get all this crazy, noisy data between the employment survey and the household survey. Nobody can seem to figure it out. I don't think it's a bad thing to get a couple months confirmation rather than get all joyful because, used car prices might have fallen a little bit.
Yeah, that's a great point. I think one thing that maybe investors are starting to have some tension with is this idea of data dependence, because, markets want policymakers to be somewhat forward-looking. And the idea that we're just looking at these backwards inflation reports and then judging what inflation's doing, it does create a lot of tension and, obviously a lot of uncertainty in bond markets. That's why, rates markets have really had a hard time making heads or tails of this.
I posted this to X. Tom, I don't know if you had a chance to see it before you came on, and I was just showing the divergence between the Dow and the NASDAQ. I know nobody cares about the Dow. It's just more like a media index. But the way the NASDAQ keeps going up, the Dow is actually down recently. Over half its stocks are down in the past 3 months. There's the chart. Thank you, guys. And actually, 273 of the S&P 500 are actually lower over the last 90 days, Tom, even as we make record highs. Are you worried at all about just this? I know we've talked about it before, but this massive concentration at the top and so many companies that are just not participating.
Well, yeah, I think it's probably one of the sort of fly in the ointments, or one of the things that's getting investors nervous, is that it would be better to see better breadth. And of course, I'd love to see the Dow keeping up with the NASDAQ. I think part of this is that monetary policy sort of having hawkish pauses, and the idea that the Fed, is still keeping on the table the potential for hikes.
Yep.
Means it's really hard for stocks to break out, because at the end of the day, CEOs have to say, well, if the Fed's going to be raising rates, I'm going to stay cautious, and that's what's keeping stocks cautious.
All right, guys, this is the part of the video where I'm going to break down the stocks that were mentioned in the CNBC clip. Today, they just talked about inflation falling, which is going to affect the whole economy, which is the SPY, the QQQ, the Dow, and the XLE is an energy ETF that they briefly touched on for a little bit, so we'll break that down. But we'll start with the SPY. You can see it is a very bullish pattern. We're respecting this 45-day moving average in blue, and here's the 200-day moving average in green. We've been rocket shipping up ever since November. We have not looked back. We had one pullback in late April. We found a bottom. We made a higher low, then another higher low, and then we've blasted off ever since. We had another pullback exactly to the 45-day moving average, rejected going lower. This low is way higher than this low, so another higher low and another blast off. And as of right now, we had a green day on Friday. We're still looking bullish. We're basically at all-time highs, guys, and ending the week on a green day means we're going higher. The QQQ, basically the same. We started this run in November. We've been respecting the 45-day moving average very nicely. When we finally get to it, we start touching it, and then we break through it viciously. Once we come back up, we touch it, reject it, and then we break through it again. So it's very much respecting this 45-day moving average, guys. If you don't have it on your chart, maybe think about adding it. As you can see, the overall economy ETFs are respecting that 45-day trend line very much, coming almost to a penny to touch it and reject higher. The QQQ did end at all-time highs on a Friday to end the week, guys. That is very, very bullish. Several higher lows put in here. A major higher low put in this one. The 200-day is still down here for major support if we ever break through the 45-day, but most of the time we don't get near the 200-day. That's when you get very, very good buying opportunities. And right now we're so bullish with so much momentum, I don't even see us coming back to the 45-day for a little while. Here's the Dow Industrial Average. Definitely not an S&P 500 or a NASDAQ for sure, but they are doing pretty decent. They're holding that 45-day moving average as well. You can see they're kind of rejecting to the downside. They had this massive day that was going to break up, and it's got completely rejected straight to under that 45-day moving average, guys. That is not an accident. If I had to guess, this is going to be going lower. You could also argue that they have an ascending support line right here. So all of these are higher lows, and this could be another higher low to keep going higher. Right now, it's kind of in the middle of nowhere. This could be a very aggressive double bottom. This could also just be a leg down, rejection at the 45, and another leg down. So on the Dow Industrial Average, I would keep my stop loss pretty close if you wanted to trade it, because this can go either way. When it breaks either 392 to the upside or 383 to the downside, there will be a pretty major move either way. So just something to keep an eye on. And then here's the energy ETF. Definitely not an S&P 500 or a NASDAQ. This is, I don't even know what this is. This is the energy ETF. I would not put my money in this. Obviously, it's not doing as good as the S&P 500, but you can see we've got a leg up, cool off, leg up, cool off. This ETF is actually respecting the 200-day moving average a lot more. You can see it made it support several times back here. Then we broke under it, made it resistance, then broke above, and now we're coming back to tap it. So we'll have to watch how it reacts with the 200-day moving average. We'll have to see if it's going to make a support and start going higher and make a new all-time high, just like this pattern here. Or if this is the top and we're going to start coming all the way back down to 80 and potentially lower. You do have a lot of lower lows and lower highs here, so this is definitely bearish for the time being. There's no reason to get into it just yet. Wait for it to start consolidating sideways and get some green days in before you even think about buying it. I hope you guys enjoyed the video and the breakdown. If you did, maybe hit that like button and subscribe, and I'll catch you in the next video. Peace.